Ever wondered how the performance of the stock market is measured? Well, it's not done by a team of people crunching numbers all day, but rather by a handy tool known as a market index. Yes, market indices are the unsung heroes of the financial world, tirelessly tracking the performance of a select group of stocks round the clock. Think of a market index as a measuring stick, a yardstick, if you will, for Wall Street. It's like a scoreboard for the stock market, displaying the performance of various stocks. It's not just any random group of stocks, mind you. These are carefully selected stocks, often representative of a particular sector or the overall market. Now, some of you might already be familiar with a few of these indices. The S&P 500, for instance, is one of the most well-known indices out there. It tracks the performance of 500 of the largest companies listed on stock exchanges in the United States. Then, there's the Dow Jones Industrial Average, or DJIA, another heavyweight in the index world. It's been around for over a century, keeping an eye on 30 of the most influential companies in the American market. And let's not forget the tech-savvy NASDAQ composite. This index is the go-to for anyone interested in the technology sector, covering a whopping 3,000 plus companies, most of which are tech and internet related. But why are these indices so important? Well, they provide a snapshot of the market's performance at any given time. They help investors, analysts, and even everyday folks like you and me understand the health of the market, the economy, and by extension, the state of the world. So, next time you hear someone talking about the market being up or down, you'll know they're probably referring to one of these market indices. In essence, these indices are the pulse of the financial world, giving us a sense of the market's heartbeat. Market indices, the measuring sticks of Wall Street, are like scoreboards for the stock market, and understanding them is your first step towards mastering the market. You might be asking, how do they calculate these indices? It's not as simple as you think. Indeed, it's not just a game of addition or subtraction. The calculation of market indices involves certain methodologies that aren't as daunting as they sound. Let's delve into the world of these methods and see what they have in store for us. First up, we have the price-weighted index. As the name suggests, this method gives more importance to the stocks with higher prices. The Dow Jones Industrial Average, or the DJIA for the finance enthusiasts among us, is a prime example of a price-weighted index. Remember, in this method, a $10 stock will have twice the weight of a $5 stock. Next, we have the market cap weighted indices. These indices are all about the size, or should I say, the market capitalization of the companies. The bigger the company, the more weight it carries in the index. The S&P 500 is a shining example of a market cap weighted index. So if a company's market cap is twice the size of another, it gets double the weight in the index. Finally, we have the equal weighted indices. Now, this is where things get democratic. Each stock in this index carries the same weight, regardless of its price or size. Imagine a world where all stocks are created equal. That's precisely what an equal weighted index looks like. But why do we have these different methods? Well, each methodology offers a unique perspective on market performance. While the price-weighted method emphasizes the influence of higher-priced stocks, the market cap-weighted method highlights the impact of bigger companies, and the equal-weighted method provides a balanced view of all stocks. So there you have it. Each method has its own quirks and charms, but they all serve the same delicious purpose: giving investors the lowdown on market performance. Why should you, as an investor or finance student, care about market indices? This question might be bubbling in your mind. Well, the answer is simpler than you might think. Market indices are not just numbers on a screen. They are the pulse of the financial world. They are the compass that guides investors through the turbulent seas of the stock market. Market indices play a crucial role in evaluating the performance of investments relative to the broader market. They act as benchmarks, providing a standard against which the performance of individual stocks, mutual funds, or even entire portfolios can be compared. This is crucial in helping investors make informed decisions about where to place their money. For instance, let's say you've invested in a mutual fund. Now, how would you know if your fund is performing well or not? You compare it with a relevant market index. If your fund is outperforming the index, give yourself a pat on the back. If it's underperforming, it might be time to reevaluate your investment strategy. But market indices don't just provide benchmarks, they are also indicators of overall economic health. When indices are on the rise, it often signals a robust economy. When they fall, it could be a sign of economic downturn. By keeping an eye on market indices, investors can gain insights into broader economic trends and make investment decisions accordingly. Moreover, market indices help in diversification. They represent a broad spectrum of companies across various sectors. By tracking these indices, investors can spread their investments across these sectors, mitigating the risk associated with investing in a single sector. In essence, market indices are like the headlights of a car, illuminating the road ahead for investors. They provide valuable insights, helping investors navigate the complex labyrinth of the financial world. They are the tools that turn the chaos of the stock market into a comprehensible landscape. So, whether you're a novice investor dipping your toes into the financial waters or a seasoned finance student honing your skills, understanding the importance of market indices is key to your journey. Market indices, the backbone of the financial world, bring order to the chaos of the stock market. But wait, there are some common misconceptions about market indices that we need to clear up. Now, you might think that market indices are the be-all and end-all of the stock market reality. After all, they're the scoreboards we've been talking about, right? But here's the thing, they're not perfect representations of the market. Shocking, isn't it? You see, indices are like a snapshot of a bustling city. They capture the high rises, the landmarks, the hustle and bustle. But they can't possibly capture every alleyway, every mom-and-pop store, every hidden gem. Similarly, market indices track the performance of selected stocks, not every single stock in the market. And here's another twist. Even the stocks they do track aren't always represented equally. Remember those calculation methodologies we discussed earlier? Depending on the method used, some stocks might have a greater influence on the index than others. So if a heavyweight stock sneezes, the whole index might catch a cold. There's also the misconception that a rising index means all the stocks within it are performing well. Not necessarily. An index can be driven up by a few high-performing stocks, even if others are lagging behind. It's like a team winning a game because of one or two star players, even if the rest of the team didn't play their best. And lastly, not all indices are created equal. The S&P 500, the DJI, the Nasdaq Composite, they all track different types of stocks and sectors. Some might be more tech-heavy, others might focus more on industrial stocks. So they might tell different stories about the market at any given time. Even with their limitations, market indices remain an invaluable tool for tracking market performance. So next time you see that scoreboard, remember, it's a useful guide, but it's not the whole story. It's a bit like reading the headlines of a newspaper. To get the full picture, you need to delve a little deeper. So there you have it, folks. We've taken a thrilling ride through the bustling world of market indices, the scoreboards of Wall Street. We've seen how these indices are not just arbitrary numbers, but rather meticulously calculated measures that track the performance of select groups of stocks. We've met the big players of the league, the S&P 500, the Dow Jones Industrial Average, and the Nasdaq Composite. We've also dived into the fascinating methodologies used in their calculation, whether price-weighted, where the price of each stock determines its influence, or market cap-weighted, where the size of the company plays the starring role, or even equal-weighted, where each stock gets its fair share of the spotlight. Each method brings a unique perspective to the table. We've understood how these indices serve as benchmarks, helping investors assess the performance of their investments relative to the broader market. They are not just tools for the financial experts, but are fundamental for everyone who wishes to venture into the world of investments. And let's not forget their importance in bringing order to the chaos of the stock market. By distilling vast amounts of information into a single number, they provide a snapshot of market trends and overall economic health. But remember, while market indices are powerful tools, they are not crystal balls. They cannot predict the future of the market, but they can certainly give you a sense of its rhythm and pulse. As we wrap up this journey, let's keep in mind that understanding market indices is just the first step. The world of finance is vast and exciting, filled with opportunities and challenges. So continue to learn, continue to explore, and most importantly, continue to invest wisely. Stay tuned for more financial fun, and remember, invest wisely and always keep your sense of humor handy.